Welcome to the Overberg Asset Management Market Review.
Good day, I'm Carel la Cock, COO and Director at Overberg Asset Management, based in the Hermanus office. The balanced view between the bears and the bulls. Okay, so we'll kick off with the capital economics report. So on risky assets, they think there will be a pause in the coming months before surging in 2024 as the easing cycle starts, economic activity picks up, and the AI hype builds. So they've got quite positive return forecast for 2024 and 2025, and I think Nick has covered that in previous reports, but it's in the region of about 20% equity market return. So, I think we're probably more in the camp of capital economics, but we take a balanced view to be cautiously optimistic. Bond yields expected to fall further as investors move to discount more aggressive central bank rate cuts. So as I said, they believe that the markets haven't quite grasped how quickly rates may be cut. So not just in next year, but also in the following couple of years. So equities surged in November, but their view is that it'll be quite choppy in the next few months. And the surge in November was mostly because of risk-free rates supporting valuations. The next few months could be choppy as economic data points will likely disappoint in key economies. Strong gains in 2024 and 2025 as the AI hype fuels a stock bubble. So commercial property is outperformed in November, although the office sector failed to recover, and the spreads of BBB commercial backed securities continue to widen. So I think in that asset class, it's the office sector is still treading a bit of water there. And then commodities mostly struggled in November, but precious metals rallied on a weak dollar. And we saw the gold price hitting record highs in November. So their view, safe assets will continue to rally over the next couple of years, largely due to belief that investors are still underestimating how quickly and or how far many central banks will cut interest rates over the next couple of years. And while capital economic thinks risky assets may struggle over the coming months, they forecast strong returns over 2024 and 2025 as yields fall back and economic growth rebounds. Equity markets will notch up large returns as they benefit from growing excitement around artificial intelligence. That could lead to the formation of a bubble in stock markets over the coming years. This will be most of a tailwind for stocks in the US and other developed markets. And I think on the back of that, we've increased our exposure to the US and also the tech. So I think that kind of resonates with our views as well. Just diving into sort of what's happened in November. So November equity rally, we had total returns above 10% for developed market REITs, Latin American equities, US equities, and also European equities. On the flip side, energy commodities returned more than a negative 5%. So even after this rally, global equity and bond total return indices still below their 2020 peak. So there's still some runway on those. The current benign market environment reflected in lower volatility. So looking at a few volatility indices, they've normalized, and that's largely because inflation. So the US CPI figure that came out in November was quite encouraging. US economic data have largely held up to expectations, so there weren't any surprises there, as well as elsewhere are no longer disappointing. Bond rally the bond rally is reflecting falling term premium. So the US 10-year Treasury term premium is back down to zero. And only a few months ago, that was trending upwards and caused quite a bit of volatility in that 10-year yield. And then strong returns from most bond indices over the next year. And that's because central banks to cut rates by more than investors are discounting at this stage. So the US stock market strength off the back of resilient earnings. So in Q3, most S&P 500 companies, when they announced their earnings, largely beat expectations. So I think that was a strong quarter of earnings reporting. The US equity rally is still largely driven by the Magnificent Seven. And so just quickly having a look at what's happened with gold. So precious metals racked up large gains in November. However, this was broadly in line with other safe assets. So if we now go over to MRB and their asset allocation, so as I said, they're a lot more bearish. And the title of their report is A Maturing Cycle, but the end is not yet nigh. The global US recession is not yet on the cards for 2024, although the lifespan of the economic expansion is inevitably shortened. So while the Goldilocks scenario may persist for the near term, aided by the recent drop in bond yields, a resilient global economy will keep core inflation sticky at well above central banks' targets and preclude the significant interest rate cuts that are currently discounted by the markets. So there will be another meaningful upleg in yields before interest rates will have reached a sufficiently restrictive level to end the economic and investment cycle. So they say premature to conclude a bull market is underway. Bonds are unwinding an oversold condition, and markets are overly aggressive in forecasting Fed rate cuts in a year ahead. So they have a neutral stand on a bond allocation in a multi-asset portfolio. And you can see that's in contrast to the view capital economics have. A resilient global economy will provide temporary support for equities. However, on a 6 to 12 month horizon, MRB continue to view cash as the most compelling play and recommend overweight exposure within a multi-asset portfolio. So they've got bonds, equities at neutral, commodities at neutral, and then cash actually overweight. And I think that is a good sort of counterbalance to the exuberance of the market. It gives us a reason to be cautiously optimistic. And on the currency, US dollar will weaken in 2024, notably against the euro, yen, and an emerging market basket, but the currency will fare better against weakly linked currencies. And if we remember those weak links being countries like Canada, Australia, and I think also the UK. So why is MRB so bearish? Well, the message is a little bit mixed. So one of the reasons, the economic and investment risks are still elevated. There's still a war in the Middle East, which could escalate. Next year, we have a divisive US presidential election looming with implications on US fiscal policy, regulatory and broader economic impacts, and also foreign policy. I think we can all remember Donald Trump's foreign policy of a few years back, and I think that could be quite detrimental to global trade, but also to the US. Interest rates are still not restrictive enough in the US and to a lesser extent in the euro area. So interest and debt servicing costs for US households and corporate sectors are still comfortable relative to income levels. So many households would maybe still be on fixed interest rates that they locked in during the period of sort of zero interest rates. So many of those households still benefiting from that. And it's only when they have to refinance that they'll start feeling the pinch. And then a continued tight labor market. As we know, tight labor markets have upward pressure on wage growth, which ultimately will keep that inflation sticky. On the flip side, global manufacturing and trade poised to strengthen. PMI figures in the US, Germany, Korea, and Taiwan all showing positive signs. And that has obviously a positive impact on corporate profits and equities. Bond volatility will remain elevated, and that extra volatility will impact on investors' risk appetite. So just finally, the last sort of word from MRB, conditions are supportive in the near term, but the 6 to 12 month equity outlook is complicated by pronounced divergence between the average stock and the global and US benchmarks, as well as elevated valuations and earnings for large cap growth stocks in the US. An expected upturn in global manufacturing and trade should be positive for corporate earnings, especially for select non-US markets. But we expect US stocks to struggle to break to fresh cyclical highs. And that concludes my little presentation. So I'm going to hand you over to Gielie to update us on the local market.
Thank you, Carel. It was an impressive and interesting presentation. On the local side, the Reserve Bank kept the repo rate the same at 8.25, and the prime rate will be 11.75. Carel talked about the bulls and the bears, the interest rate environment. We don't talk about bulls and bears. We talk about hawks and doves. The hawks always want to drive the interest rates up, and the doves want to keep it low or even go lower. In this case, for this interest rate decision, the decision to keep it the same was unanimous, which indicated that it was a dovish decision. They didn't want to go up. They didn't want to be hawkish and push it up. Other figures that came out is the new vehicle sales, which was sales were down in November by 13%. It's quite a lot. And I think it's just a sign of the route that the economy is going in. Everything is, it's not, production is down and confidence levels are down. So it's not very positive at the moment. And I think that came out when the GDP growth figures came out. We had a negative quarter. The GDP growth for the third quarter was minus 0.2%, compared to the previous quarter, which was originally 0.7%, but it was brought down to 0.5%. So those percentages actually came down. It's not very, very good. And the year-on-year figure is even worse. The year-on-year, the economy is down minus 0.7%. And if we repeat this in the fourth quarter, we will be in a recession, what they call a technical recession, but it will be a recession. The other figures that came out is the ABSA PMI figure, that is for the manufacturing industry. That is a positive figure. It came up from 45 to 48 points. This is a figure that maybe must be above 50% to indicate growth, and below 50% it indicates contraction. So this one is up from 45 to 48%. It's still contraction, but it's a little less contraction than at the 45 figure. The producer price index year on year, that also came out. It was 5.1%. It is now 5.8%. So that is going up. And PPI is basically just the inflation rate at the factory gate or at the farm gate. So if that goes up, it could have an effect eventually on the inflation figure. I just want to repeat, it's up from 5.1% to 5.8%. It's a 0.7% gain. It's not small, it's rather big. I've read about yesterday about the interest costs of South Africa, of the country as a whole. The interest costs on South Africa's growing debt pile is at the moment 1 billion rand per day. That came out in the MTBPS in November, and the collapsing freight rail, the Transnet, is also costing us $1 billion per day. That's also from the mini budget. And load shedding at the moment is also costing us 1 billion rand per day. That came out in the High Court when the Minister of Electricity told that to the court. That is basically all for my side, Carel. Not very good news, all of it.